Assets. What is an asset? Assets are the first element of the accounting equation and can be defined as anything that can be owned or controlled by the business that provides a future benefit. So that's probably a very accounting definition of assets. But if we look at an actual example, for example, you buy a piece of machinery, it has a future benefit as we can use it to manufacture goods. Therefore, it is an asset to the business. However, if we merely repair the machine, there is no future benefit in that. It's just to pay the repair bills, so it's only an expense. So you need to be asking yourself, is there a direct future benefit from this cost? While there may be an indirect one in the case of the repairs, there is no direct one. So in the case of actually buying the machinery, it is an asset, but if you actually only repair it, it is an expense. In addition to that, the benefit also needs to be owned or controlled by the business. Merely having access to something is not enough. It needs to be controlled or owned by the business. For example, if you have access to your mum's car, but you don't control or own it, it's not an asset. However, if you bought one on your own, or you went in with a friend to buy a car with a 50% share, then it is an asset to you. This is a useful scenario to remember when trying to determine whether something is an asset or not. Assets can also be broken into the subtypes, current or non-current assets. Current assets are those that are consumed in a 12-month period. Examples of this include cash and inventory. Cash because it's always being used. Inventory because you turn it over multiple times per year. Non-current assets are those that you plan to hold on to for longer than 12 months. Examples of these can include buildings, motor vehicles, and land.